Hello, good afternoon. You've tuned into MF Corner on CNBC TV 18. I'm Vinnii Motiwala. Thank you so much, as always, for tuning in. Now, today, what we're going to be putting the spotlight on and focusing on is going to be smart beta funds. How do these funds work? How are they supposed to be placed in your portfolio as a strategy? What is the difference between traditional mutual funds or index funds? What is the difference there? To discuss more and all of this, we have Rushabh Desai, who is founder of Rupee with Rushabh Investment Services, joining us to answer all of that and help us understand smart beta funds. Rushabh, good afternoon. Thank you so much for joining us on the show as always. Let's start by understanding smart beta, right? That's become quite popular in terms of how does it work? Could you tell us how is it different from regular funds? What is the strategy that one should apply here?
Hi, Vinnii. Very good afternoon, and thank you so much for having me on the show. Vinnii, smart beta are nothing but index funds in the end of the day. Okay. Just like traditional index funds, these smart beta index funds have their underlying indices, and these smart beta index funds will follow exactly in line with the underlying indices. Okay. Just like a traditional index fund, smart beta index funds will invest in the same index and invest in the same stocks and in the same allocation as which has been decided. Now, what makes smart beta funds different from the traditional index funds is that smart beta index funds are basically aligned and work on pre-decided rules and algorithms. Okay. Now, these rules and algorithms can be based on multiple factors, like say, for example, alpha or momentum or quality, value, low volatility, etc., across different market capitalization, which gives a unique blend and gives a unique combination of active and passive strategy at much more lower cost. So to put it simply, a traditional index fund is basically market cap driven, and a smart beta index fund is basically will have multiple rules and algorithms based on multiple factors across different market capitalizations.
Okay, Rushabh. Rushabh, then what sort of investors or what type of investors should actually consider putting money into smart beta funds?
Vinnii, technically, all type of equity investors can invest into smart beta funds. Usually when an investor invests in the equity markets, we usually recommend based on the market capitalization anywhere between a time horizon of 5 to 7 years. Okay, say if a product is say like a large cap product or a flexi cap product, then a minimum time horizon of 5 years works best. But if a product is more inclined towards mid caps and small caps, then of course a 7 to 10 year kind of a time horizon needs to be given. But all investors across the board, large cap, mid cap, and small cap investors can invest into smart beta products. Let me give you some very beautiful data, Vinnii. Now, see, for example, as I mentioned, that smart beta products include alpha and momentum. Now, alpha and momentum strategies are kind of like high risk, high volatile, and high cyclical products. They will give you higher returns during a bull market, means they will have a higher upside capture ratio, but at the same time they will also have a higher downside capture ratio as well, which means that when the markets go down, when the markets enter a bear market phase, then alpha and momentum, particularly kind of strategy smart beta indices, will have severe negative double digit drawdowns. So if an investor is investing into say like a momentum or an alpha kind of a strategy, and which is more inclined towards mid and small caps, then the investor needs to be very aggressive, needs to take high risk, and needs to be prepared for very high volatility and cyclicality. And a time horizon of say 7 years to 10 years needs to be given. But if someone doesn't want to take too much of risk, doesn't want too much of volatility in one's portfolio, then there is a very beautiful product called low volatility smart beta index fund, which invest into only low volatility stocks. And these low volatility indices prevails in the Nifty 500 universe as well as the Nifty 100 universe as well. So if an investor is absolutely conservative, then a low volatility large cap index fund, smart beta index fund would work best. But if someone is willing to take slightly higher risk, then a low volatility flexi cap smart beta index funds would work best, Vinny.
Okay. Rushabh, you did highlight in terms of type of investors, what kind of smart beta funds could they look at. But overall, just in terms of among the current smart beta categories available today, and in this time and scenario that everything is going around, where do you see the best opportunity right now?
Vinny, see, currently the best opportunity lies in the momentum strategy and momentum style smart beta funds. Why do I say this? See, number one is that momentum strategy has underperformed, has been the worst performing style in 2025. It continues to be the bottom performer in 2026 as well. Of course, we have seen a decent amount of recovery since the bottom, which was made in early of 2025. But still, momentum as a strategy has given anywhere between -18 to -21% drawdown from its all-time high, which was made in 2024. So I think number one is that playing contra is the best way to make money. No one has made money by investing in a bull market or in a product which has done phenomenally well. You have to be a contrarian in the market to make money. So I feel because momentum as a strategy has been the bottom performer, I see tremendous margin of safety, number one, and I see tremendous of upside opportunity when the next bull market cycles. Also, I want to give you one more data point, Vinny. Momentum strategy over the long term has been the top consistent performing smart beta index when I compared it with other smart beta indices. To give you a perspective, see, on a 10-year daily rolling returns basis, momentum strategy across Nifty 500, Nifty mid cap, and Nifty small cap have given anywhere between, say, 20 to 23% compounding returns on a 10-year daily rolling returns basis. This is on an average. So I feel if someone invests in the momentum strategy at this point of time, I think in the next bull cycle and the bull market, I think a lot of money will be.
Okay. Rushabh, I have a question in terms of one. Why should investors look at smart beta? What is the sort of return? If you could talk a bit more in terms of that. Also, what is one of the biggest risks also that comes in, right? Because one should be careful while investing in a smart beta fund as well, or anywhere. So one, what is the biggest pro here in terms of returns also, as well as in terms of risk also, if you could highlight that.
Vinny, let me take the second part of your question first. See, technically, we cannot control returns. Ultimately, we can manage risk and control risk very well, right? Now, the biggest drawdown and the biggest risk what smart beta indices face is that they will be 100% invested in equities, okay? Like an active equity fund manager, smart beta indices won't be able to take cash calls. And, the fund managers will not be able to intervene quite regularly, which they do in an active fund compared to a smart beta index fund. In a smart beta index funds, the amount will be fully invested, and the rebalancing will happen either on a quarterly basis or on a half yearly basis. There will be no rebalancing and intervention in between. So to put it simply, the downside risk management will be quite tricky in a smart beta index funds, because the fund manager is not taking cash calls and is not intervening from time to time. When the markets fall, the smart beta index funds will have severe drawdowns. But at the same time, the pro and the most beautiful thing of a smart beta index fund is that they have been consistent outperformers. An active fund will outperform and at the same time underperform from time to time. I'm not saying smart beta index funds will not underperform, but historically what data has shown is that on a 10 daily rolling returns basis, smart beta index funds have been more consistent and have outperformed more number of times compared to many active funds out there. So I feel that having a smart beta index funds in one's portfolio will help to diversify, will also help to minimize the underperformance risk. and at the same time will give you the much needed consistency in terms of delivering superior risk adjusted return, which is required from an equity fund, Vinnii.
Okay, Rishabh. You know, should smart beta funds replace active funds in a portfolio if you have too many active funds? Is it advisable maybe to add smart beta in your portfolio? And if yes, what percent should it be as well?
I mean, you see, first of all, I wouldn't recommend someone to create a full smart beta portfolio is because of the downside risk what it possesses. I think the best way to 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 create a portfolio is to have a mix of both active funds and index funds. Now, the index funds can be smart beta index funds or traditional index funds as well. So I would suggest that if someone is creating an equity portfolio of say 5 or 6 funds, I think one or two smart beta index funds can be given a place in one's portfolio, and anywhere between say 15% to 40% of exposure can be given to smart beta indices, and the rest should be allocated to active equity funds. Because see, let's not forget that active equity funds has its pluses. And it's very natural for funds to outperform and underperform from time to time. So from a diversification point of view, I think introducing one or two smart beta index funds amongst the other active funds should do the job.
Okay, Rishabh. Thanks so much for the advice there coming in on smart beta funds. But hope that helped you all in your investment journey as well, viewers, in terms of smart beta funds versus index funds and the allocation that should come in there. But on that note, we're going to slip into a very short break. After break, we're going to come back and we'll focus on how investors should actually declutter their portfolio. How should you go about that? Stay tuned in. Welcome back to MF Corner on CNBC TV 18. We still have with us Rushabh Desai, who is here to answer questions now on how you should be decluttering your portfolio, any doubts that you all have on that, and what is the strategy, at what time should you all look at decluttering it as well. Rushabh, at what point of time should an investor realize that maybe I have over-diversified and now it's time to declutter my portfolio?
Vinnii, see, technically speaking, you really don't require more than 5, 6 equity funds. Okay. So if someone is having more than 5 to 6 equity mutual funds in one's portfolio, that clearly means that he or she has over diversified, and the overall portfolio is under over diversification risk. Now, why I say this is that, every mutual fund will have anywhere between say 30 to 70 stocks. If a mutual fund is focused oriented, then probably anywhere between 20 to 30 stocks will have in that particular fund. But if it's a well diversified fund, say like a flexi cap fund or a value fund or a mid cap or a small cap fund, on an average, these kind of funds will have anywhere between 50 to 70 stocks. So I think overall, when you create a 5, 6 mutual fund portfolio, you're anyways investing into more than 100 stocks. So technically speaking, you don't require more than 5, 6 equity mutual funds. And if someone is investing in more number of funds beyond 5 and 6, then it is definitely leading to over diversification risk.
Absolutely. Not more than 5, 6 funds is what someone requires in their portfolio. Rishabh, but when someone decides that, okay, chalo, now I need to start cleaning my portfolio, where should they start with? What sort of funds maybe they should look at removing from their list first? Or how should they decide on which ones to let go?
Vinnii, this is a great question. See, first of all, rather than, asking the question where, I think first and foremost, investors should start cleaning up only during a bull market. Now, why I say this is that, see, when the equity markets enter a bear phase or a negative period, investments would be hit, returns would have shrunken, and returns would have gone into the negative territory as well. So during these kind of negative phases, shrunk return phases, it's not ideal to clean up one's portfolio. It's ideal to do the cleanup during when markets are high, or when valuations are high. I think that is the best time. This is number one. Number two, to answer your question very specifically, where to start, I think starting by removing underperforming funds is very important. Analyze your funds on a 5, 7, and a 10-year daily rolling returns basis. And if you feel that your fund is heavily underperforming the respective index on a 5, 7, or a 10-year returns basis, then the fund does not deserve a place in one's portfolio. Now, there are certain funds which may underperform on a 5 and 7-year returns basis, which is very natural, especially value and contra funds. So I think little more time will need to be given, but on an average, anywhere between 5 and 7 years is ideal. But if a fund is, say, little more on the volatile or on the cyclical side, then the fund may need some more time to prove its outperformance. This is number two. Number three, also one should look at assess based on one's risk and time horizon. So why I say this is that someone would have invested in a fund which does not their existing risk profile or time horizon, right? Someone may not have high risk, but if someone has invested in a high risk product, or someone may not have that much amount of time horizon, but still would have invested in a high risk, high volatile, high cyclical product. I think underperforming funds and looking into your risk and time horizon is something very important.
Okay. Obviously, key highlights that you've given over there, underperforming funds also is something that you should look at, as well as on the basis of your risk. But Rushabh, is there something that in terms of taxes also that comes in as a concern? What time of the year maybe they need to look at? Is it during the year end, or maybe it is better in terms of some taxation side? Is there some benefit on that front? And also, after decluttering the portfolio, what is the ideal portfolio that one should have in terms of different kinds of funds?
See, I think first of all, one cannot avoid taxation. Okay, let's be the fact. The only way is, what I would recommend is, don't take hasty decisions by decluttering investments which are less than 1 year. Because if you're decluttering, if you're exiting products which are less than 1 year, then of course you will need to pay a higher taxation in terms of short-term capital. But at the same time, you will also need to pay an exit load as well. So I think looking at investments which are more than 1 year is very important. And number two, in cluttering and cleaning up during a bull market is something very important. Then it really doesn't matter whether you're getting out at the start of the year, middle of the year, or end of the year, Vinnii.
Okay. Rishabh, thank you so much for joining us on the show this afternoon and giving us your insight in terms of what one should be doing to declutter their portfolio as well. Thank you so much. And thank you so much, viewers, for tuning in to MF Corner. But up next, you have Closing Bell to take you through the last hour of trade.